Hello there, I am Shamla. In lecture series 2 of my corporate reporting lecture series, I will look at some of the chapters of the conceptual framework of financial reporting. In my first lecture series, I covered the accounting equation of assets equal the sum of liabilities and equity. And to ensure the equation remains in balance, we adopt a double entry bookkeeping system. The important question at the end of the first lecture series is how do we decide if an item should be recognized as an asset, liability, or equity, the three broad headings in the statement of financial position. These broad headings of assets, liabilities, and equity can be further subdivided with assets broken down to non-current and current assets. The same for liabilities. It is subdivided to non-current and current liabilities. Finally, with equity, it is further broken down to share capital and reserves. To ensure consistency in how an item should be recognized, a good place to start is to look at the definition of assets, liabilities, and equity as prescribed in the conceptual framework of financial reporting under Elements of Financial Statements, Chapter 4 of the conceptual framework. We will start with the definition of an asset. The conceptual framework defines an asset as a present economic resource controlled by an entity as a result of a past event. The conceptual framework uses the following key words in the definition of assets. Firstly, economic resource. This is a right that has the potential to produce economic benefits. Next, control, meaning in recording transactions, we should apply the important concept of substance over form. That is, the recognition to represent the underlying reality of the transaction and not be based merely on legal form. Finally, past event. Given the financial statements are actually a summary of historical transactions. Question: how do we decide if an asset should be classified as non-current or current assets? Items meeting the definition of assets that are not easily convertible to cash and have a useful life of more than 1 year, meaning the ability to generate economic benefits for a period exceeding 1 year, should be presented in the statement of financial position as non-current assets. Liquid assets should be presented as current assets in the statement of financial position. Finally, I will look at examples of non-current and current assets. Items such as property, plant and equipment and investment property should be included under tangible non-current assets. Tangible meaning assets with physical substance. Assets without physical substance, such as goodwill and intellectual property, should be included under intangible, non-current assets. Investments, for example, in shares or bonds intended to be held for a period exceeding 1 year, should also be included under non-current assets. Liquid assets such as inventories, receivables, cash and cash equivalent are presented in the statement of financial position under current assets. In the second part of lecture series 2, I will look at the other elements of financial statements, that is liabilities, equity, income and expenses. Till then, thank you and have a nice day.